Welcome to the Cresco Wealthcast. My name is Dimitri, Korolis. I'm the host of the pod, and I'm also an advisor within the Cresco Wealth Management team. Just want to say a quick thank you to all of you that continue to support and follow the channel. I appreciate you, and of course, welcome back. And if this is your first time to the podcast, thanks for stopping by, and I hope you enjoy. At the Cresco Wealthcast, the inspiration was very simple. I wanted to bring topics that were derived from real conversations, and I wanted to do it in a way that was relevant and relatable to you. And a lot of the conversations and the content that you're going to hear, it's coming from clients, it's family, it's friends, it's just being out and about and having those real conversations. Nonetheless, I hope you enjoy, but before I let you go, just want to let you know you can find us on LinkedIn, Facebook, Instagram, and YouTube. Just search at Cresco Wealth Management. Till then, enjoy the pod. Oh, and by the way, that music you're hearing, that's Pete Ems. He's one half of Small Town DJs, and it was nominated for a Juno Award. He's on the team. No big deal. We've got a really exciting podcast, one that I think is not built necessarily for everyone, but for those that it does apply to, definitely worth a look. I want to introduce my guest, and I'm going to nail it this time. Tatenda Mawoyo.
Just like my mother says it.
Hey, one for one. We're doing it already. Well, I appreciate it. Tatenda's joining us today from GBL. He's the manager, client relations and development, and GBL is an actuarial company dealing specifically in individual pension plans, IPPs. So again, I'll just reiterate, it's individual pension plans. We're going to reference it as IPPs for the remainder of the podcast. We will definitely let you know what it's about. But first, I just want to thank you for joining today. Yeah, it's excited to have you, and we already share a common relation of lack of sleep around the household.
Exactly, some young kids in the house, so got some coffee on hand. We'll do all we can.
So how is it? Is it as advertised, the Cresco coffee?
You know what? When I listened to the first episode and I heard you guys mention it, I said if he offers me this coffee, I'm going to say yes. And I got to say it's pretty good. I'm having it black, and it is hitting the spot.
You know, you made Peter on the team. So Peter's the coffee guy on the team. That's okay. The big one. He did a big favor for all of us here. So yeah, happy you enjoy. Yeah. And you get to take some home for you.
Oh man.
There we go.
It's what a deal.
Yeah, you have to. So we'll jump right into it. I mentioned it already. You are very knowledgeable and very versed in this topic. It's really what you all do over there.
Correct.
And it's the individual pension plan. The first basic question, why don't we do a little one-on-one for the first few minutes? Really, what is an individual pension plan or IPP at a high level?
Yeah. So first off, thank you so much for having me. I really, really appreciate it. What is an IPP? I think the best definition I can give that, not too technical, but really kind of tries to hit it on the head, is an individual pension plan, an IPP. It's a corporate pension that's designed specifically for business owners and incorporated professionals. So the idea of GBL is when we were started, back in the early 90s, you'd have all these pension plans that the government employees would have, right? If any listeners are familiar, maybe it's the term defined benefit pension plan, right?
Okay.
People at very large corporations would have access to them. Government employees would have access to them, things like teachers, things of that nature. And the idea of GBL was, look, these are things that are available in the Income Tax Act for everybody to take advantage of if somebody's incorporated as a professional, if they have a business. So what we try to do is to make these things accessible and doable, just for those small and medium-sized kind of market. So it's a corporate pension plan that's designed specifically for business owners and incorporated professionals to take advantage of.
Okay, and that's really good. So again, as we said, it's really designed for a certain type of need, and it is very niche at that stage. But so I'm a business owner, let's say, at what stage does it start to make sense to really want to look at this or entertain it, the necessity versus just the want?
Yeah. Man, so I hope I don't say this too much, but like I mentioned, I did listen to a few of the episodes, and one thing I heard yourself and Peter mention, and it really stuck out to me, is you guys would make the comment that one of the biggest grinds when it comes to building wealth is taxes.
That's right.
In terms of just the tax you can pay along the way. So then that really has a strong influence in terms of when somebody will start taking a look at this. The earliest it generally makes sense is age 40. right? And the reason for that, if I can explain it very briefly, is as business owners and corporate professionals, something they always have access to is something like an RRSP, right? So you can, pay yourself a salary from your corporation. The government gives you contribution room in an RRSP to take advantage of. We might be familiar with the math. It's 18% of your salary up to a certain maximum is what you can put in. When you take a look at the math that's behind or under the hood for an IPP, it just so happens at age 40, because that's when somebody's going to potentially make the switch, right? To say, that's when somebody might say, on a go-forward basis, I'm now going to stop putting money into an RSP and I'm going to favor an IPP instead. And it just so happens that at age 40 is when an IPP starts to give more contribution room compared to an RSP. So that's the earliest it generally makes sense to even start to think about making the switch.
So it's not to say we're stuck on age 40, but just statistically, when someone is well into their career and then at a particular age, that just seems where the transition would start to happen. So that is true. I mean, you touched on it about how it is different from an RSP from a contribution room perspective. I think a lot of light bulbs are going off as people are listening. But what are some of those key differences where you look and say, hey, we're switching from what you've been doing here to make the IPP make sense?
Yeah, great question, man. I can probably mention 3 or 4 key differences in terms of the switch again from an RSP to an IPP. And the way I think about it is, let's take a look at it from, what are the limitations of an RSP, right? Because it's typically when somebody hits any of those limitations that we start to look to see, hey, what else is available to me? So the first one is obviously the contribution limit, right? It's 18% of your salary. So if somebody's in a position where they could theoretically fully fund the RSP, maybe let's throw in TFSA in there as well, and we could use more room to kind of get some of those tax deferred advantages that I'm sure we'll talk about in a little bit. That's one of the advantages, right? It's an IPP is going to give access to more contribution room. That's still tax deductible, it's still tax deferred, investment growth is still tax sheltered, right? But just more room than we can utilize with an RSP. So that will sort of be the first advantage. And obviously, if you can put more into one thing versus the another, you just get access to more tax deferral, right? Because it's just a bigger bucket that you can fill up. So some of the other maybe more niche differences that kind of come into play. One would be, in income splitting with the spouse. If somebody funds their own RSP or RIF, typically it's after age 65 where you can start to income split with the spouse. Obviously, the exception is if somebody actually intentionally funds a spousal RSP, but in terms of your own plan. One of the benefits of an IPP is as early as age 55, as somebody makes withdrawals from the IPP, they can income split with the spouse, right? So just for somebody who might be thinking of maybe retiring early, that can be a pretty decent advantage.
That's a massive advantage for sure. Yeah.
And maybe one more I can throw into the
please.
mix here, Dimitri. It's again, I listened to another one of your podcasts, right?
I love it. You're the most prepared. You're already my favorite.
There you go.
You've already beat all the guests.
Yeah, I got to return the favor for giving me this wonderful coffee. But I know there was another podcast, you and Peter, you talked about the value of time, right?
Absolutely.
Right,
Yes.
just the value of time in terms of how long you can keep your money working for you. And obviously the next consideration becomes where you keep the money, right? And typically things like TFSAs, RSPs, they work because of some of the tax advantages, right? Probably one of the key ones would be as money is growing within those accounts, you're not paying tax right away on the growth, right? Especially an RSP. So where an IPP kind of gives key differences, I'll kind of give a hypothetical scenario if I can, right?
Of course.
So imagine I'm in a scenario where I've fully maxed out my RSP, right? We have some volatility in the market, right? It can happen, right? Like a 2008 or what have you. Assets go down. I can't put any more money into my RSP to make up for that difference, right? If for some reason to reach my goal I need to put away more money, I kind of have to look at other accounts types that might not be as tax efficient, right? Where an IPP differs is when, let's say, returns are below a certain benchmark, or maybe the market just tanks for whatever reason, somebody actually has the option to put more money into the IPP to make up that difference, essentially to bring the IPP assets back to where they'd like them to be. And those additional contributions, we call them top-ups. So they're optional, but they're also tax deductible to the corporation that's funded the plan. So it's just a nice option, right? If we do the math on the IPP and we say, look, based on how returns have shaked out, you actually have the option to, even though you fully maxed out your IPP, you can actually now put in still more money just to bring those assets back up to where we want them to be, and you can still claim tax deductions.
You know, and that's a great advantage, because if you think in the times of the down market, even where one would, let's say, we take the standpoint of looking for an opportunity, because time is huge. A lot of actions that we do in our world and in your world, they happen on an annual basis or at a face value.
Right.
But it really is those face value decisions. You need that time for it to mature. So what you're saying is there's a good opportunity to say, well, maybe market conditions aren't the best, as opposed to having nothing available. You could do those top-ups, forecast for longer, and you get the deduction.
Right.
You did talk about tax. This leads me into another question. Let me throw a hypothetical your way. We play the idea tennis, as I call it.
Let's do it.
I'm not good at tennis.
Yeah,
so
neither am I, but let's pretend.
Yeah, we'll pretend. Yeah, you will pretend. But the question that I have is, so one capability that we have is to manage corporate accounts. You have those that have corporations, they have the corporate assets. We open up the corp account here, and we invest the funds accordingly. At what point, in your opinion, do we look and say, okay, Dimitri, client A, B, client X, this is when they should start looking not so much the age perspective, but the buildup within their corporate account to start maybe appropriating funds to an IPP?
Yeah, that's a great question. But to your point, it's a corporate pension. What that means is, unlike an RSP where you fund it personally, if somebody sets up an IPP, they're essentially using their corporation to fund this IPP, right? Okay. So the contributions come directly from the corporation. So just a key factor there. Something else I should mention in terms of kind of going back a little bit here. I guess we're kind of talking about key qualifiers, right? In terms of, we already mentioned there's an age consideration. Another key consideration is similar to RSPs. There needs to be salary in the mix, right? Okay. So what I mean by that is, just like how I pay myself a salary, or I get paid a salary, I guess, and that creates RSP contribution room. Same thing for an IPP. If we want to access this contribution room, client A has to essentially be paying themselves a salary from their corporation.
So someone who's giving themselves just dividends would not apply here.
Exactly.
And it's very important to distinguish that there is a difference from a tax perspective, what a dividend, what a return of capital, what a salary / income means. So we have to take a salary / income from the corporation.
That is correct.
To bring forth that room that isn't similar as an RSP.
Exactly right. Great. It's me saying I own my corporation, but at the same time I'm also an employee of my corporation. So I'm going to use my employer, which just happens to be a corporation I own, to set up this IPP for me. Now to your point about another consideration in terms of retaining, consideration in terms of retaining within the corporation. Things I often see come up, it's number one, it has to do with the maybe amount we've retained in the corporation. I don't know how in depth we want to go with this here, but their accountant is going to be at the table, right? So sort of a team approach, right? Where I probably be, it's me, you, Dimitri, the client CPA is at the table as well, and we're kind of having that conversation, right? Yeah. But you're completely right. Is the way the Income Tax Act is written is, once somebody does a good job of retaining or saving in their corporation, once their passive income gets to a certain point, baseline like $50,000 passive income within the corporation, they start to lose access to the full, small business deduction, right? Kind of the $500,000 first profit that's taxed at the small business rate that starts to get whittled down. So oftentimes when an IPP does begin to be discussed, is maybe somebody has already retained in their corporation and they've built up such a large portfolio that it's starting to essentially have a negative impact on the benefit of using the corporation for tax deferral. Right. And then in that case, what the need becomes, we don't want to keep building up these retained earnings within a corporation, because it's just going to make the problem worse and worse and worse. So as we're looking for different ways to pull money out of the corporation so we don't have all those tax issues, oftentimes an IPP is looked at because it allows us to pull money out of the corp. The corporation gets the tax deduction on anything that's funded into the IPP. And at the same time, we're not creating a taxable benefit for the individual right away, right? As if I have a corp, I can pull money out of my corporation into this IPP, and I'm not paying tax on the money that's going into the IPP right away, so I gain it. removing it from the tax exposed environment.
Okay, perfect. Because that was, I wanted to stay on tax here and say in an RSP, essentially, because you've already paid the taxes on income earned, I'm going to say from a personal standpoint, and when you make that contribution, essentially you're for ease today, you're offsetting the taxes paid. Okay. Same. So I have a corp. I have capital gains in the corp. I move those capital gains or what's in that gain position. I realize them. I move them into the IPP. Do I get to work the same way with the deduction?
Yeah. So for that one, if it's capital gains, that's more from I guess the selling of, let's say, active or assets in the corporation that we use for active purposes. Then yes, we do see a lot of that. So as a quick example, oftentimes it's maybe somebody's getting close to retiring. They're selling a bunch of assets they had in their corp. Right, so you've got all these capital gains that are going to be taxable, and so somebody might look at an IPP, to fund it, to sort of offset the tax on the taxable half of those capital gains, right? So for sure, there's a lot of different applications and strategies we see.
Okay, that's
there.
Great. Yeah. So it has that versatility, and not to, it is it's complex in its simplicity here, but to put it is really what we're saying. Hey, you have a corporation. And your accountant or your advisor or your team just says, maybe it doesn't make sense to open an RSP per se, but really what we're doing is in just bringing that into the corporate world of having that type of retirement package. Right. The one thing I wanted to ask is, from you have the tax advantages. I'm just trying to draw the parallels again, I'm just trying to think of the questions that someone listening right now might be asking.
Right.
Does carry forward room apply? Do you get to predate it? So for example, if I miss the boat for 20 years, do I get to go back in time? Or if I make a contribution in 1 year to an IPP and I don't for 5 years, the business maybe needs different focus, or the corporation, do I still earn that room over the years? Maybe take us through those types of scenarios, Tatenda.
Yeah, great question. Let me try to attack that, I guess, chronologically in terms of the life cycle of the IPP. So let's say somebody wants to set up this plan. So we set it up, and one of the things we do at GBL is we have actuaries on staff, and all these are kind of like the nerds of the nerds, and they're the ones who kind of do the calculations, following the rules in terms of what can be funded into a plan. Now to your question, one of the things we look at when we set up an IPP is we do the math to recapture any past contribution room that was quote unquote missed. Now what I mean by that is oftentimes it's not right at 40 everybody's able to kind of start saving for retirement in this at this magnitude, let me put it like that.
So it could be like a doctor, for example, that says, listen, I'm finally earning the salary that was promised to me after all the money I paid in school, trying to get the business or myself off the ground. Typically they're focused on paying down and debt management.
Exactly.
So let's use that, because I'd imagine you get a lot of medical professionals that are in this.
Oh yeah, 100%, right? Well, somebody might be, for example, let's say they're 50 or 55, right? But they have been paying themselves a salary from their corp, let's say, since they were 40, so 15 years in the past. Essentially what we can do is do the math, pretty much say, look, if you had an IPP over the last 10, 15, 20 years when you could have, how much could you have funded into it above and beyond what you've done in your RSP? Right, and then we essentially do the math to kind of credit that catch-up contribution room. It's called past service, if anybody's ever come across that term. But that's what it is, right? It's you might feel like you missed the boat, but not really, right? We can do the math to kind of give you that additional contribution room that you could have factored in. So that's the first thing. Now your next question is what somebody already has an IPP, or let's say we set up this past service room, and it can be significant, right? It can be hundreds of thousands of dollars. The question I always get is, hey, do I need to fund this all at once? What if I don't have the cash flow? What if it makes sense for me to spread it out? I think one of the greatest benefits we have in the IPP world is that the contributions are flexible and they're not forced, right? So if we set up a plan and we say, look, this year you can fund $200,000 based on past service or what have you. If it makes sense to fund it all now, great. If you want to do like half of that and then carry forward whatever you haven't used up to future years, you can do that as well. Right, so to your point, somebody has contribution room that they've earned they don't have to max out this year if it doesn't make sense for whatever reason, right? Nobody's going to force you. You can just kind of take advantage of it as the years go by.
Okay, no, that's really good. Let's fast forward now. So, you and I are 40.
Right.
We each have our corp. We've each appropriated funds to an IPP, and now we're retired.
Right.
Okay. So we're go-getters. We're retiring at 55. Right. This is the scenario we're painting.
Yep.
We retire at 55. At 55, again, I'm bringing that up specifically just in an earlier question that we had, is we're taking advantage of income splitting.
Right.
And so I want to use all those advantages. So at 55, we're retired. What does drawdown look like?
Right.
Does it become similar to, let's say, when an RSP converts to a RIF and there's a minimum you have to draw?
Yeah.
Can you do it? Like, how does it work on that side for our listeners?
Yeah. Okay. So essentially, there's 2 or 3 options, which I think is beneficial. Somebody can make a decision based on what's best for their situation. Mm-hmm. So option 1 would be we're going to treat this IPP as a pension. And what I mean by that is whatever we funded into it is essentially going to stay. The bulk of it, the bulk of their principal is going to stay in the IPP. And then I'm going to take a pension, like an annual or a monthly pension from this IPP. Now, the way that works is I did make a comment kind of in passing at the beginning. I said an IPP really is a defined benefit pension plan. Mm-hmm. And what that means is there's a calculation that's done to figure out, based on your age and how much salary you've paid yourself, what pension are you entitled to be paid from this IPP, right? And so we do the math, and it works out to be whatever it is, right? It might be, I'll just throw out a number, let's say it's $75,000 a year, right? Yeah. And so then that's the amount that's paid out on an annual basis from the IPP.
Sorry to cut you off, Tatenda. So there has to be some planning.
Yeah.
Whereby what you actually pay yourself can pay, no pun intended, but those dividends later. So if you're looking for a particular desired outcome from your quote-unquote defined benefit / IPP plan, you want to take those things into consideration on the lead-up.
Yeah, okay. 100%.
Yeah.
And that's why we like to, let's say, work with teams like the Cresco team here, right? Because we know you guys are going to do some of that wealth planning or financial planning, right, in terms of this is sort of the end goal, and then now maybe let's work backwards to see how big do we want this IPP to be.
Huge,
right?
huge. I'm big on that too. Sorry to segue, but it's always the retirement question.
Yeah.
And people say, Dimitri, what's the magic number that I get to retire with? That's one way to look at it.
Yeah.
I challenge and say, well, one of the things you want to look is, well, what do you want your cash flow to look like in retirement? Because reversing the math is huge. But you're right, with planning and things like that, is at least identifying what you want that end goal to look like.
Right.
So you can begin and put these structural items in place.
Yeah.
But do you have more on that? Sorry, I know I cut you
off.
No
worries.
Because I wanted to ask what happened. Let's talk about death beneficiaries.
Yeah.
Let's talk about that scenario. So, it belongs to somebody. We can't talk about growth if we don't talk about the demise.
It does. Maybe I can add maybe 1 or 2 more things on the retirement piece. If that's
please.
Okay.
Yeah, that's why I was absolutely.
Yeah. Mm-hmm. Yeah. So it's so like I mentioned, if somebody retires in the plan, there's a calculation done to say what's your pension. Typically that pension is going to be maybe indexed with inflation, right? CPI goes up by 5%. Somebody might choose, if they want to say my pension is going to go up by 5% as well. But I'm sure as you're thinking, or listeners are thinking, it's a bit more restrictive in terms of it's more of like a locked-in withdrawal amount that you're tied to on a yearly basis, right? Which for some people it's fine, right? IPP can help form kind of that foundation. You've got your IPP, you've got your CPP, and then maybe we make more flexibility. The flexibility comes from the TFSA, the non-reg, the corporate account, or what have you. But sometimes people do want more flexibility, right? In terms of I want more access to my money, right? So in that case, what happens is we can always, at any age, if a client wants to, we can always terminate or wind up the IPP, right? Like close it out. Now, the way that works is we say we're going to close this IPP. We move over as much as we can from this IPP. It goes to what's called like a LIRA or a LIF, a locked-in RSP. Mm-hmm. Typically, it's about, let's say, 80 to 90% of the assets can go to that account tax deferred. Right, the other 10 to 15 is going to be paid to the individual as a taxable lump sum.
Similar as a pension.
That's just like a pension.
Yeah.
Just like a pension.
Yeah.
And then obviously once that principal that can go to a locked-in account is in there, In Alberta, for example, I believe you can unlock up to half of it to a regular RSP or RIF, in which case now you're going to have more of that flexibility if somebody wants to.
Okay, so there is that transferability, flexibility there,
exactly.
which is a great point. A great point. So you're right, and again, bringing it back is what we're doing is you're saying this is an opportunity to which, if you have a corporation, there is that option and optionality out there.
Yeah.
I want to close with two last questions, and we're running really good for time.
Awesome.
And actually maybe three, but the last question might be you answering about 8 more other questions.
All right. Well, to be determined.
Yeah. So the first one is this: industries that you typically work with. If you could just name off a few.
Yeah.
And also, what are some industries that you work with that maybe they think they wouldn't apply for something like that? We talked about doctors and medical professionals, but have you ever encountered, have you ever encountered other industries where they said, oh no, this wouldn't be for me because I'm doing that, and they said, well, surprise, you're actually in the conversation for that.
Right.
So who are you working with mostly on these items?
Yeah. So I say probably the biggest tranche of types of individuals who take advantage of this would be, I guess, incorporated professionals, right? So this would be if I can just rattle off, it's sort of your physicians, your dentists, your engineers, accountants, lawyers who are incorporated. I'm not sure if I mentioned engineers. So typically we see a lot of them taking advantage of this IPP for different reasons, right? It's retaining in a corporation used to be one of the main benefits of incorporating for these professionals. But with all the tax changes that have happened since 2016, 2017, there's so much I know we could talk about.
Yeah, that's a podcast in its own.
In its own,
right?
yeah.
You know what? I wouldn't mind. Maybe we could set up maybe a presentation if you're keen on it as well.
Yeah.
And because that is one of those what I call the boardroom. Everyone has their hands up question.
Yeah.
And if we give them one, it'd be nice. We'll tease them for the next
right,
episode.
There you go. Stay tuned. Stay tuned.
But that's in its own.
Yeah,
for sure.
Right. So we're retaining the corporation just isn't as, from a tax perspective, it's just not as advantageous as it used to be, right? So a lot of these professionals, they look at something like IPPs just to, again, get more money out of that tax-exposed corporation into something that's tax deductible, tax sheltered. One thing I didn't mention is strong creditor protection. Some of these professionals are kind of planning for, or not planning for, they're just concerned about that, wanting credit to protect more of their assets, right? And then on the other side, you look at incorporated business owners. Now, for there, to be honest, it's super varied, right? I've set up plans for everybody from businesses where they run a large construction company to somebody with a very, very successful flower shop, right? It's super varied.
That's why I ask,
right?
Because
exactly.
Again, the natural instinct is incorporated, so the dentists, the doctors, the lawyers, you say, but there's so many other industries that are operating very similarly, but they just don't believe that they are.
Right.
Yeah, absolutely. No, that definitely answers the question.
Yeah.
One thing I wanted to ask you too is, and again, I will throw the disclaimer: we don't hold you to this right now unless you want to have specificity. But just to give everyone an idea, what would be, and if there is a cost to something like this, how do the costs typically work for someone that wants to put an IPP into place?
Oh yeah, that's a great question. And I'll put exact numbers as of today, February 2026, I guess.
Yeah, there we go.
This,
and just know that I did the disclaimer.
Exactly.
I don't know who else does that, but I'm looking out for you.
Oh man, there you go.
He's a father of 3 now.
Yeah, coffee disclaimers. I mean, I am spoiled today.
Too spoiled.
Too spoiled.
Oh,
right.
Good.
So I mean, that's a great question, right? Because and if I can, I think one of the reputations around IPPs is that they are complicated or overly complicated for somebody to consider. And first, I mean, so some agreement to that, right? It's an IPP is not like an off-the-shelf kind of RSP, TFSA, where there's lots of material out there. It's super easy to kind of set up. Just walk into a branch, you can kind of do it.
Yeah, you're right. Like we're trying to set up the parallels today for understanding, but that is a good point.
Right.
It is different.
It is different,
Yeah,
exactly. Okay. But the reason I mentioned that is we now have firms like my employer GBL, where our job is, we're not here to replace what Dimitri does, right? We're not involved in asset management at all. Right, somebody wants to set up an IPP, they work with you to build a portfolio. We have no hand in that. We don't charge anything on assets or whatever, right? We're not here to replace accountants or CPAs, right? So we don't do any of the corporate stuff. What we do is we come into the picture specifically to help with every new thing that's introduced because of the IPP. So this is the setup, this is the admin, this is the compliance. We're actually registered as an authorized consultant with the CRA, which means that if CRA has any questions, they'll obviously reach out to the client, rightfully so, but they also reach out to us directly, right? Because our job is to, all that sort of complexity, all the new stuff, that's what we handle, right? So that for the client, for their team, it's sort of business as usual. So the reason I mentioned that is for fees in terms of what they might be, how they might be compensating their investment advisor, that stays the same. The CPA, that stays the same. For our fee, we typically charge for a one-member plan. It's a flat $1,700 a year.
Okay. That's an ongoing annual fee.
Ongoing annual fee, okay. Right? And the thing, what that covers is, for example, that's in the first year, that's the setup. So like drafting all the legal documentation for the IPP, submitting it to the CRA, kind of managing the registration process. On a yearly basis, I love CRA, and CRA loves filings and forms. And so for every sort of CRA form for the IPP, we draft that, we complete those, we submit them to the CRA.
You've already proven the justification for work
exactly
done.
Yeah. And the last thing I'll mention is like I mentioned is obviously because IPPs have such strong tax benefits, obviously the CRA is going to want to make sure that
they're looking
like what we put into this has to be compliant. It has to be within the rules, right?
Yeah.
So what the CRA will say, you need to work with an actuary that's going to calculate how much can actually be funded into this IPP. And we need to do those calculations once every 3 years. And that fee includes sort of those updates as well.
Okay.
Yeah.
Okay. Absolutely. No, it's good because, I try to ask the questions as best I can for everyone, right? And to get to that. And again, we're at that 30-minute mark, man, time flies. Holy smokes. Wow. I feel that I've just scratched the surface with you on this one. I'm already my hamster wheel's turning on some other things that I'd love to have you back.
Right.
That'd be awesome. And coffee's always awaiting there.
Oh man, I need it.
Yeah. But I really appreciate your time. I really appreciate helping to educate the listeners as well. And you touched on it. I'll leave this with you to somewhat close. Is again how things work. Do they reach out to you directly? Is it better for someone to say, hey, talk to Dimitri, help facilitate? How does that best work in your world when you're entertaining whether it's an option for a client?
Yeah. So I would say what's going to work out, lead to the best outcome for a client would be, hey, reach out to Dimitri, right? Because we're advocates that the decision to do an IPP shouldn't be made in isolation, right? So you're going to want to work with somebody who's going to look at the entire wealth plan.
I was hoping you'd say that.
Oh,
that's great. Thank you.
Yeah.
If it went the other,
I know, right?
Pause.
Pause. No, but it's true, right? And so it's and then we have a relationship where typically you're going to bring me in then to help with the IPP consideration. I'm not sure if I mentioned this, but we do complimentary illustrations to help clients and somebody like yourself to look at the plan. So we're not going to charge for that. It's just we're going to help you give this a fair shake, right? We can have all the conversations that are needed with you, with your accountant. We'll kind of run the numbers. And then if it makes sense, then obviously we formalize the working relationship. But I say if somebody's interested, if somebody reaches out straight to GBL, go for it. But we're always going to say, okay, we've given you these numbers. Yeah. Now you need to go talk to your team to see if this is actually a good idea for you.
And it's it's true. Not again, and I appreciate that, not just because you're saying it, but again, our job as wealth managers is we're looking at that 360 view, right? And I like that. And we say the same thing as, you touched on it earlier. We said, look, I'm not your accountant. I'm not doing the accounting things. I'm not the financial or wealth advisor. I'm not doing those things.
Right.
And it's got to make sense for everyone. What we will do is really make that assessment and identify how it looks towards the plan, because at the end of the day, everyone is different.
Yeah.
Everyone is different. So appreciate it again. Thank you so much for coming down and chatting with me and our listeners as well. Again, if you have any questions, reach out to myself, whether it's on the website. You can go to the website. My direct contact information is there, as well as in the bio, and we can get those conversations started to see if it is a viable option.
Right.
Again, thank you for your time. individual pension plans is what we were talking about today. Share this one with a friend, anyone that you think, again, this is corporate, not personal. I want to make that distinction, but looking forward to having you back. Thank you.
Thank you. It was a pleasure.
Awesome. Hope you enjoyed the episode, everyone. Thanks for stopping by. Please feel free to leave your comments, or even if you want to let me know topics that you think I should be talking about. You can find us on LinkedIn, Facebook, Instagram, and YouTube. Just search at Cresco Wealth Management. And last but not least, if you want to be up to date with our newsletters, our insights, and even our events that we host throughout the year, you can reach out to me directly. It's pretty simple. You can just go to our website, find me from there, crescowealthmanagement.com. Thanks again, everyone.